the rest of the world as well as we showed up against Belgium. I fear for our children's future.
Yeah, I hear we may be deporting illegal immigrants from Belgium right now that are coming to play soccer.
Honestly, for those that actually follow football, that was probably one of the most embarrassing displays that I have seen in the entire World Cup.
It was
also
embarrassing.
Americans on field. They just didn't show up. I mean, I said this last time. My daughter's a goalkeeper. She's going to play college in goalkeeping. I've coached goalkeeping. He had a bad game, no doubt. But a goalkeeper is also only, and he had a terrible game. His decision making on that one goal was just excruciating when he didn't just kick it away. You do not have time at that stage. I see this in teenage soccer where they want to get that extra step for that perfect kick. You do not have that time at that age or at that stage to react or to take an extra step. That's what makes the European, not just the European, but the South Americans and now the Africans so good. It's just trigger, instinct. He didn't. He thought about it. He got burned. But what was infuriating, his back line. Oh my gosh. It is one of the worst coordinations between the goalkeeper and a back line I have ever seen. And I am discussing that from the teenage level. I have never seen it that disorganized. It was absolutely humiliating. Just terrible display of soccer that day.
I think bad play all the way around for that whole team. And I think that was the first game I watched Team USA play. I didn't even watch the preliminary rounds because there were so many and it was doing stuff. But I have to say that watching it was embarrassing. I mean, I used to play goalie in high school, and the only reason I played goalie is because I hate running. I played soccer, so I loved it though. You dive around, you punch the ball away. It was just fun. It was just more of a there's always this saying you have to be a little soft to play goalie, and it's true. You got to be a little bit loopy to play because it requires a little bit more aggression and craziness to play that position just because of all the stuff that goes on. But I will say that for the most part in watching the World Cup, there have been some goals where it makes me wonder, did that goalie even react? That's not how it would have played that. I've seen that in a few times where the goaltending has not been bad in the World Cup, but there's been some times where I'm like, is this guy even paying attention? He didn't even react into a play where he should have. And there have been some good goaltending too. I've seen some games in the past week. I've seen some really good goaltending. So
incredible. Morocco only stayed close with France because of their goalkeeper yesterday. It was the goalkeeping's been awesome. I mean,
what do you mean stayed close, Doug? I wouldn't call that a close game. The only thing kept it close was Mbappe missing the penalty kick. What's wrong with you?
I mean, he stopped his penalty kick, and he also had 4 or 5 tremendous stops in the first half before the dam broke. If you watch the whole, I don't know how much if you watch the whole thing, but by halftime, I believe the statistics were that Morocco still had 0 shots on goal the entire first half.
There was one shot.
One shot.
One shot to 9.
Yeah, exactly. And he'd stopped them all. And so you lose 2-0. Yes, he did get 2 goals scored on him. But by that point, Kirk, holy crap. I mean, you're going to get 2 goals scored on you when they're shooting on you every other play. The entire game was in the Morocco half.
Well, to be fair, those are unbelievable goals. I mean, Mbappe's goal was awesome. I mean, he just picked that corner. There's no way the keeper could have gotten it. The second one, maybe the keeper he got a hand on it, but either way, it was a good shot that was screened. I mean, France deserved to win, hands down.
That top spin on that Mbappe shot was incredible. A lot of goalies will curve it. That was top spin. That is, people that don't play soccer, that is incredibly technically difficult.
And a quick one too. He didn't have time. He just popped it real quick. It was impressive.
And I will give this too. He burned the back line, and that's where the goalie at that point. I mean,
yeah. Well, either way, I'm not a soccer nut, but I will say it is fun watching the World Cup. The first half usually sucks because all they do is just. Somebody sent this meme out on X the other day, and it was from The Simpsons, and it was they were watching soccer. and you basically have 4 guys passing it back and forth, and the other team's standing there and they're passing it, and everyone's cheering, and then eventually like, hey, do something. So it's hard to watch the first half because it's usually boring because they're passing it around. They're not taking risks, which I think is really my objection to the game. It's just like it's like watching golf. You sit around watching a boring sport until a handful of plays, which are really exciting. That to me is hard, but it is fun to watch when it's when they're actually like, I'm trying to remember which game it was. It was a game recently where it went back and forth, like 1 goal, 1 goal, 1 goal. And it was awesome because they were being aggressive. They were taking chances, and it was fun to watch. I just wish there were more games like that. I know strategically it's not the best way to play, but it's more fun as a spectator to watch that kind of play.
100%. And yeah, the first half, I mean, these are great teams. That's another reason the first half is boring. It really is coming down to attrition when they finally get to, I mean, Morocco did a good job stopping what it could until it got too tired to keep it up. And that's what you're finding. For those that aren't going to penalty kicks, you're finding that the reality is it's just which team is going to be able to hold energy longer in these games, even if there's details that aren't necessarily in the game that aren't necessarily even, like France versus Morocco. They're good enough in aspects to be able to hold. And by the way, I'm going to say this. Why are we talking about it? Because as we discussed last on Monday, there's not that much else to talk about right
Seriously.
now. I'm going to be really sad when the World Cup's over because middle of the season baseball is boring. I mean, it's good. It's enjoyable. It's a nice summer pastime. But, October, is when all the action happens. August is when we get back into football, which there's always action, at least in America, that American football still draws the eyeballs. But right now, the markets, the world, it's just kind of same old. So, I mean, we got some other things to talk about, but it's challenging.
It's hard.
Right now.
Yeah, yep. Summers are hard. I mean, it's so boring. I'm growing a summer beard to keep me entertained, which I usually save for vacations, but I might start early just something to bring excitement in my life. But in all honesty, the markets, the only thing remotely exciting about the markets is the fact that there's a military conflict / war going on, and it's not on, it's on, it's not on. This week it was back on again. Apparently the ceasefire's over and Trump bombed a few things and oil prices went up. And I don't know what's going on today, but frankly, this is why we've been saying patience and caution, because who the hell knows what's going on? I mean, you really think the war is going to end? No, I don't think it's going to end by midterms. I think Trump's going to probably declare it ended, and then we'll get into midterms and people will be like, yeah, whatever, dude. Like, I think, people stop believing Trump about the war because, and to be fair, it's not just Trump, it's everyone. It's the news, it's the politicians. I don't believe anyone about the war. I don't believe the smart financial analysts about the war, because no one knows. No one knows what's going on. Unless you're over there counting ships going through the Strait of Hormuz, or you're counting missiles going off, you have no freaking idea what's going on.
Well, and let me add this. Even if we did know what's going on, this is the reality of Middle East conflicts. They don't move from war to peace. They never will. They move from active conflict to frozen conflict to proxy conflict to economic warfare to cyber attacks back to active conflict. So
it's a Cold War.
We cannot stop thinking of this in terms of war versus peace. It's the question is, and I think this is the part that brings it back to markets and everything and economy, is we have to ask what level of instability is now permanent, because the markets aren't pricing peace. They're going to price probability. They'll live with permanent conflict. It is what it is. It'll settle in. They'll live with peace if we can finally get away from it. The problem is, this is the Middle East. It's always been the Middle East. It's what killed Afghanistan isn't the Middle East, but it's that same kind of bubble of political, warlord run, area of, Southwest Asia that ultimately is a slog, and there is no real goalposts to pass, and it will wear you down the longer you're in it. And the reality is that time frame is indefinite. There is no endpoint. So.
Yeah, I mean, I'll give you a quick primer of what's going on out there. I mean, here's here's last week. Here's the weekly returns of last week, right? You saw technology in certain sectors doing well, certain software wasn't again, but semis and that, but you saw a lot of rotation, right? So forget that. You saw big tech was kind of lukewarm for the most part, but what you really saw was rotation to all these other sectors: industrials, healthcare, utilities, consumer staples. You saw a lot of rotation, right? But then if you look at this week, because the quote unquote war is back on, what did you see? You saw rotation out of all of these areas, out of healthcare, out of industrials, out of utilities, out of staples. And what did you see? You saw technology keeping us afloat. And what's interesting to me is if you look at these two charts, what you'll see is a contrast. What big tech stocks were down last week? Meta and Tesla were down. The other ones are kind of lukewarm. Microsoft's down. What did you see? Almost the opposite, right? See almost the opposite this week. And so what tends to happen is when the markets are down, people flood into like semis and big tech, because that's where people are flooding to. Look at this. I mean, this is this week. Look at Visa, MasterCard down like 4%, GE's down 4%. Lockheed Martin, you got healthcare down like 2.5%, some of the cases like 5%. Like you've got these big names that are just down for no reason. And what's up? Basically, AI related or semiconductors is up. Should they be? Probably not. I don't think the fact that we're going back to war means that you have to put all your money in semis, but that's what's happened. And we've seen this over and over again in the markets, where the markets are rotating out of areas that they should be in into other areas. So what else happened? Well, what else happened was you saw certain areas drop. You saw a 30-year bond drop, bonds across the board drop, which means yields went up, so the prices went down. You saw areas like the small caps, which was doing well, they dropped. Silver dropped, gold dropped, orange juice, natural gas dropped, European stocks dropped. But what went up? Well, S&P went up a little bit this week. Nikkei is still hot. We talked about that in the past. Nikkei is a good area to be in. Bitcoin's up, soybeans. You've got wheat, oats, heating oil, coffee, and cocoa's up a lot. I don't know why cocoa's up a lot, but it is. So, you see these areas, and you're like,
for years, it just seems to keep hovering up there.
Which one?
Cocoa.
So cocoa's actually, and this is something, if you follow the confectionery industry, which is very small, it's like 2 companies, but if you follow that, if you got like Nestle and Hershey, basically, there's 1 or 2 others, but those are the big ones. So if you look at those companies, like Hershey, for example, Hershey's a great company. It's well run. There's many interesting things about Hershey. I won't get into them, but the interesting thing is, if you look at the stock price, it's gotten hammered in the past year because cocoa prices, which cocoa primarily I think it's like 70% off the top of my head, comes from Africa. And they're having a problem with the crops over there, with cocoa crops. And that has skyrocketed the price of cocoa, which is dropping the profits of these confectionaries, right? They need chocolate, they need cocoa. So if they're going to get it, they're going to have to pay more, but they can't exactly pass that along to the consumer because, that's a problem. So they're taking on the chin their stock price, and they have been for a while. Now that should clear up. The cocoa prices should clear up later this year, early next year. I'm not following it closely because all you have to really do is watch the stock price to figure out where cocoa prices are going. But, if you look at, and actually I'll bring it up and I'll share the cocoa, the chart for it, because I think it's instructive. So if you look at the chart of, let's see, bring up cocoa. Okay, here it is. It's canola, wrong one. Lumber. Okay, cocoa. Okay, so if I look at this chart, this is let me share this over here. All right. Come on, computer. Help me out. Okay, so here we go. So this is cocoa prices in the last year, right? They were up quite high. and this is not the year before, this is just this past year. And if you look out the weekly, actually, I'll show the weekly too, because that'll be instructive. It'll probably help you understand the markets a little bit better. So if you look at, let's do this. Okay. So this cocoa price is normally, right? It's right around 2,000 per unit measure. And it kept going up. And then in 24, it spiked and it was high for 24 and 25. And then started to come down right around early 25, and it just kept going down. And now it's spiked up. I don't know why it spiked up. It doesn't matter, probably because of the war, but whatever. The point being is it came back down. Now, what happens? Now, relate this to a stock, right? We're talking about a stock. Let's take one of the two companies. We're just picking Hershey out of the hat because I just happen to know about it, but it's not saying it's good or bad. Now, if you look at the stock price, what you saw was Hershey's doing well, it's doing well, and then all of a sudden it starts to not do well for this period. Stock price plummeted. Went down quite a bit, actually. I think it was like 40% or something. Does that mean it's a bad company? No, it just means that their input costs have gone through the roof. It went from 2,000 up to 12,000 a unit. Well, you can't raise your chocolate bar prices by 6x. You can't have a dollar bar cost $6 now. It's just unpractical. Nobody's going to buy it. So they had to take it on the chin. They had to eat that, right? Or excuse the pun, but they had to eat that loss, not a loss, but they had to eat that in their profits. But now that's come back down. Well, now it's more profitable again. Now it's coming up. I mean, it's less profitable. So you want to know why stock prices do what they do. This is one of the reasons. The input costs going up and down. What goes into Hershey? Sugar and cocoa. What else? Not much. I'm sure there's other things, but that's mostly what drives the price of their good, right? Is their input costs. Everything else is pretty much the same. Now, granted, it's going to cost more to ship, chocolate, but I mean, our gas prices are what, double what they were prior to the war? Like $5 a gallon, where before it was $2.50. That's crazy. And yet oil prices went down to $68, whereas before they were 66, and yet gas prices are still high. That still makes me mad, but it is what it is. And I want to talk about gas and oil in a minute. But basically, if you're looking at this as an example, if you want to understand why certain stocks operate the way they do, the non-tech stocks, because tech stocks don't really have an input cost in the same way that other stocks do. But like consumer goods have an input cost. It might be cotton if you're making clothes. It might be cocoa if you're making chocolate. It could be sugar if you're making Coca-Cola, right? It could be roadkill if you're making McDonald's. Sorry. But anyway, so the point being is if you're looking at these inputs, it's really important to watch this to see, is this going to impact the stock price? And you obviously want to hear what they have to say. So if you see the top headline, which I just noticed here, favorable West African rainfall eases cocoa supply fears. Okay, great. So there's a big drop today. That apparently, I guess we lost Doug there for a minute. Hopefully I come back. But apparently that's part of the issue that's going on with cocoa prices. I don't watch it every day. I think it's kind of one of those areas that'll drive you crazy because you're talking about a crop in another country that you really have to be intelligent about. Anyway, so that's one of the things to understand about commodity prices. And if you see what's going on across the board, if you're looking at these other commodities, that's cocoa. You look at coffee. Coffee has been a problem for a while. Ever since COVID, it's been elevated. Wheat, oats, cotton. You've got all these things increasing, but realistically, what you have to watch out for is because of this military conflict, how is this impacting other inputs like fertilizer? Is that impacting our crops here? So far, we haven't seen the impact so much in the prices. And, I talk to farmers frequently, and I could say a lot of them are still struggling. So they're not having a boom time crop. Many of them are struggling. And I think we haven't seen things bottom out for them yet, but that may come soon. We'll see with this conflict if that affects crops. But I have not heard crops being affected in a major way, and certainly the futures markets, which are a good indication of impact, are not seeing that as well. And while Doug's talking, I'll try to bring up those. But if you pull up some of those crops, let me just bring them up at the moment. So if you look at like corn, corn is relatively low in price. Soybeans, relatively low in price. Rice elevated a little bit this year. It's coming up off a low. But generally speaking, the crop price that normally people were buying, the agribusinesses, there's an ETF that invests in agribusinesses, but the agricultural businesses, people were buying that because they thought, oh, the price would go through the roof. But actually, they haven't been doing so well, and the prices haven't been going up. What these businesses really need is high ag prices, and they're just not getting them. Maybe we'll see them next time around for next year if we see, we're not getting enough. But for the moment, we're not seeing the throughput into stock prices that people were expecting. So what's on your agenda, Doug, while I pull up some additional charts here on these?
Yeah, I got a couple of things. I'm gonna jump into housing for a second. Real estate, we haven't talked about that for a while, so let's get a little bit of an update. We just got some new indicators from Fred. The how in terms of median days on market. Let me see here. I thought I had this chart up, and there we go. I do. So give me a second. So basically, here's what we're finding. I'll start with this. The median days on market in the United States tracker that Fred puts out, the Federal Reserve, it showed, and I'm sharing it right now, but it shows that we're still seeing a clear.
Where are you sharing it, Doug?
I shared.
I don't have your thing. It didn't pop up.
Well, I'm definitely sharing it. So you know what? If it doesn't come through, I don't know what's going on.
You can just send it to the Slack, and I'll put it up if you need it.
Let me bite that here while I take that, and I'll I'll multitask here. So bear with me because that's always fun to do when you're live. But I'm gonna go. Get to the right channel first of all. All right, here we go. Let's see if it's going to come through. Now it's trying to get me in. Gotta love this. All right, here we go. Big 1, 2, 3. Pulling it through. You can share. All right, so very simply on this one, the chart is showing from June 20 or from May 2026 to June 2026. So just in that 1 month time frame, we are starting to see a little bit of an uptick. Where we actually ran from roughly about 52 weeks on the market, or 52 weeks of inventory. We have now jumped a little bit in June to 53. If we go back and look at a 1 year trend, though, we're still down. We were actually in inventory about this time last year, June 2025 was about 53 weeks. We're back kind of holding steady. July of last year, it jumped to 58. And then it slowly rose in August to 60. The peak was in January of about 78. I'm sorry, not weeks, median days on market. Sorry, weeks would be a little much worse. But 78 days on market in January. So we are in that period of time with the spring summer where we expect things to move a little bit more. But homes were flying off the market instantly in previous years. The properties are still continuing to sit, although thankfully we're not seeing a massive uptick. The 1 year trend is comparable. They're still sitting longer with that 53-day median this summer, and it's ultimately that chaotic bidding war era is cooling down, and that's leaving sellers more desperate to actually find they have to make moves in order to get things to sell. So, that's obviously still regional. One of the worst places that we see in the country is Florida. Other communities are not seeing near that type of stress. Now, if we look a little bit further into trends, Realtor.com 2026 National Housing Forecast Mid-Year Update released, and it is showing that home prices are growing and they're continuing at a much more sluggish trailing pace than the original projections. So clearly, we're not seeing this break, and this is going to continue to be something that is a drag on consumers because yes, We do see, more money, more cash available. We've seen some positives, in terms of, consumer flexibility. Although we are seeing, as we talked about extensively, a K-shaped economy. So if you're at the top of it, you're having much more flexibility than those at the bottom. But what we are seeing here is that, again, if you look at this as an indicator, a lot of wealth is trapped in homes and equity. A lot of decisions economically are going to be made based on accessibility and liquidity. And again, if listening to me for several years, the greatest cause of financial stress is lack of access to capital. So if it's locked in, if your home is something that you feel that you do not see the economic data to get out of, that's going to eventually have an increasing amount of erosion on confidence and erosion on spending in other areas. Another area that we are looking at, again, I don't know if it'll hopefully come through, but what we are also seeing, a good indicator is that we have actually seen Bank of America consumer chief has indicated that spending has jumped 6.3% with wage growth across all incomes. That is actually positive there. Credit card and debit card spending rose 6.3% in June. That's the fastest growth in 4 years, spanning all income groups. So not just on the top and bottom of that K, and both services and retail. Lower income wage growth jumped a full percentage point to 4.1%. That effectively closed the gap with the higher wage income earners at 4.2%. Job switching, that is the main engine behind wage gain. So if you're stuck in your job trying to move vertically, the economy has changed on that a long time ago. Changing employers typically delivers a compounding premium beyond the baseline annual raise. And ultimately, looking ahead on that, with that fastest growth we've seen in 4 years, it's broad strength. And I think that's going to, a positive. So once again, as opposed to previous economies, if we go back to 2008 and we looked at, the trends leading up to, from the late 90s into finally, the dot-com implosion. If you look at what happened in 2008, economic indicators and recession indicators at those points tended to be much more in line across the board, where you could have a much more predictability about what was going to happen in the economy. Ever since the 2008, Great Recession, this is something that has been perplexing to economists and for anyone that's trying to look at trends of our economy, because there is significant diversion between indicators that show that we are in, early, mid, late stage economy indicators versus other areas where it's showing opposite. So you might see of 15 indicators, 5 or 6 of them showing that we're still, that we're in definite late stage, things to be concerned. But at the other end of the spectrum, we might still see 5 to 6 that show that we're in early stage, even though we are clearly years beyond the last recession. And this is why I think there's continues to be a lot of question about what does this mean? Is the is the market overpriced? Are we seeing things that tell us to finally prepare, take your money off the table and wait for the next opportunity. I think that if you've heard me talk before, there's that cyclical and there's secular trends. The secular trend is the one that's very difficult to look at. Now, cyclical, absolutely. Kirk, you see this. There is definitely indicators to say, hey, things are expensive right now. Let's be more cautious. Cash is a good asset class. Warren Buffett and, now I got to stop using his name because he's not making decisions. But Berkshire Hathaway, continues to believe that holding cash is the best choice for that, to get that, for that when, not if. But the reality of it is, and that's going to give you these, these micro level buying opportunities. But from a macro trend of, hey, we are finally at a point where we need to be worrying about this economy. There's just too many things that, that conflict with each other. One of those things that's certainly going to lead to that is the Federal Reserve's decisions We talked about this earlier. They were supposed to start cutting interest rates to make borrowing cheaper, and they just hinted they might keep them higher for longer. We call this the grocery store vibe check. Even though politicians say the economy is doing great, everyday people, on the other hand, are still feeling broke at the grocery store. And that tells us, a little bit more about the why the math doesn't match how regular people actually feel. And if we're going into the midterm elections, that's going to, we're still going to have to face what's coming up the next couple of months in voting booth volatility. Coming up this November, the stock market is starting to get people nervous. We are, very stretched. Expect, it can be certainly no prediction of it, but we should expect that we're going to get potentially, once we get back into the fall, possibly greater, I'm not saying it's going to happen, but don't be surprised if we had wild daily swings based purely on political headlines as we get closer and closer to these elections. And so, the thing that's going, I talked about this a little bit a couple of days ago, the thing that's going to protect you right now from election anxiety over the next couple of months is probably to have a higher level of liquidity available that's going to give you, the security blanket. It may be worthwhile giving up a little upside if the economy just kind of breezes through it with a meh and grows. You have to ask yourself, everybody's different. Is it going to make more sense to give up a little bit of upside for the ability to give you flexibility if that volatility occurs? Or are you going to, or are you going to feel worse if you don't, prepare yourself and the economy gets more volatile and starts to pull back? But I will tell you, the other thing leading into the midterms, and I'll turn that back to you, Kirk, is they are starting to see data in a couple of areas on the tech side. First of all, the $1 trillion question. Big tech companies have spent billions building artificial intelligence. We talk about that a lot. Everyday consumers aren't really paying for those apps. It is incredibly expensive. A lot of these AIs, they start, they pay you, the charge on tokens is going to make it to where if they start charging on this, it just like so many things, there's going to be the haves that are going to be willing to pay it, that have the financial capital to do so. And the rest of people are going to be carved out because they can't afford to pay for those tokens. So, inside Wall Street's, still asking themselves, are we actually going to be able to make money from AI, or is this an expensive trend? And for large corporations willing to spend the tokens, is that enough to make AI something profitable? But also, there's so much more information from AI, so much more information from the internet, so much more information coming everywhere. They are starting to show that people are actually getting sick of the news. Brand new media report came out that showed 42% of people now actively avoid the news because it makes them feel anxious or depressed. And we call this the death of Googling. They're tired of clicking on Google search results or AI, to find AI generated junk articles, and they're turning more to private group chats, Reddit, podcasts like this for real human voice. And ultimately, if we are seeing a greater trend of people checking out of that news, then the question has to be asked, as we end up moving towards the midterms, will we actually have less impact from the noise that comes from that than we have in previous midterm elections? And that might be why, even with the war going on or not going on or kind of going on, we're still seeing the stock market just kind of shrug.
Yeah, it's, we're going through an interesting period. And one of the things I want to talk about is actually going to share here, if I can find it and pull this up. There we go. All right. One of the things I want to talk about, because, we've been talking about in the show a lot, patience and caution is the word of the day. And there's reasons for it. And if people just look at the indexes, they're like, what are you talking about? The indexes are up. I'm like, okay. And in March they were down and now they're up. But realistically, if you're looking at what's underneath the market, if you looked at it in December of '99, you'd say, what are you talking about? Everything's perfectly normal. Like the indexes are up like 58%. It's just perfectly normal. Yeah, you could, if that's how you want to read things, sure. And then the next 3 years weren't normal, according to you. So, looking at the index is not always the best marker for success or health. If you have one stock, which pretty much, or seven, let's call it 5 to 7 stocks that make up 30% of the index, and their health determines whether the index is going up or down. Does that mean if everything else is neutral and they drop 20%, well, or 21%, you just lost 7%, even though everything else is fine. You have to look beneath the surface to see, because ultimately what we're trying to determine is not, did I win today? We're trying to determine what is the best path forward tomorrow and the next day, next week, and next year. Because if we see that we're going into a recession and the stock market isn't showing it yet, maybe you should get out and sit in the sidelines. Or if you're an indexer, you'd say, well, we'll just wait it out and it'll come back eventually. Yeah, but if you see something coming, like for example, when the war started, beginning of March, the first day the markets are up. Markets are up because they didn't believe it. They're like, Trump's just going to go in and nab those guys. Yeah, he blew them all up, but we'll just get the other guy. It'll be fine, right? And then the next day it wasn't fine. And the next day it wasn't fine. And then markets were down like, 10%, 9.9 or something like that. It was down like 10% because people didn't know what to believe, right? And then once Trump said the war's over, they believed it's over, even though it's not over. So does that mean that market's healthy or not? Well, here's why I'm talking about oil. Now, if you look at crude oil, and this is a chart of crude oil, and this goes back to 22 when oil prices were up in the $120 range for a reasonable amount of time. And then you look at 26 this year, prior to the war, it was right around $66 a barrel. And then it went up to 120. A few times it spiked, but basically it was right around 100. And then now it's down to 71 as of today, but it went down to like 68 the other week. It looks like we have pre-war oil prices. Gas prices are not so forgiving. I don't know why I didn't put that chart up, but I'm going to rectify that right now. But gas prices at the pump are not showing what you would expect them to show. And I'm actually not, I think I didn't put it up because I don't think they're showing on the futures in the same way. But yeah, if I look at gas, so if I look at gas prices haven't dropped. Now, there's reasons for this, and I'm not going to put on a masterclass of how oil and gas work, but let's just put it like this: there's basically refining that happens. Oil is a commodity that is more or less useless unless you refine it. So oil gets refined and gets into your gas tank and powers your car and fleets of trucks that bring stuff here and there. So if you look at this, you see gas prices were low. They're about $2 a gallon. I live in Massachusetts, so it's $2.50 because we pay a lot of taxes, not as much as California, but something. And then they popped up, and they've stayed up here, even though oil prices are dropped. Now, there's a lot of reasons for this, but rather than get into a masterclass of this because we don't have the time, what I will say is this: what my expectations are at the moment is that we're going to continue to have high prices for a little bit because the war in the Middle East, so that's what's going to happen. And then at some point, probably towards the end of the year, early next year, you're going to see oil probably go into the 20s. Right now, it's, I think, 68, 71. I expect it'll get into the 20s, even if the war is still going on. Well, why would that be? I don't understand. What, doesn't the war mean it's high? Not necessarily. Here's what's going on, okay? And this is a little vision into the future of what you can expect. So when oil hits $100, what happens? Well, if you've got offshore drilling, they can't easily crank that up, right? In a lot of places, you can't easily crank up oil. However, in the US, we have shale oil. We could very easily crank that up. We could easily start up a pump and crank it out at $100 a barrel. And you can lock that in with futures contracts. So no matter what happens, you got $100 oil, okay? So the oil producers although it's not so simple, but just to give you a primer here. So basically, all the oil drillers start cranking out oil as much as they can. $100 a barrel, shit, that's like the top of the range. If you saw that show Landman, they actually have a great speech about oil prices. It clearly defines how it works. It's probably one of the better speeches I've seen. Actually, that show does a great job of explaining how oil prices work. So if you're really curious, there's 2 scenes in there that are really good. Anyway, so if you look at oil prices, we overproduce. We put a lot more supply in the market. The problem is demand isn't really changing. We're not using a lot more oil. We're not using a lot less oil in the US. We pretty much have the same demand, but we have a lot more supply. So what happens if you have a lot of supply and not much demand? Prices drop. But because prices are high for a long time, people are going to keep cranking that out, which means we're going to have an oversupply probably at the end of the year. Early next year, we're going to see an oversupply. We might see oil prices drop to right around in the 20s, be my guess. Now, if you look at oil prices here, last time we saw something in the 20s, if you exclude COVID, because it went down to like -20 at that time. It actually doesn't show. It doesn't go back that far. But if you go back a ways, it did hit the 20s during COVID. It hit -20. If you go back to, I think it was either 2014 or 17, it was in the 20s. We had really high oil prices and then they dropped. So there are periods of time where this happens, where it goes too high and it goes too low, and it eventually settles out somewhere in the middle. Part of the reason why energy companies are so unsexy is because you basically have this political commodity that is controlled by politics more than anything else. And you have energy companies that are cranking these things out, but it's not passing along a ton to the consumer, to the investor. So they're just not sexy, which is why they're only 3% of the S&P 500. Maybe it's 5% now because they've gone up a little bit, but generally speaking, they're not very big. They got kicked out of the Dow. They're kicked out everywhere because nobody cares anymore. Now, that being said, how should you look at this? I wouldn't touch energy companies with 10-foot pole right now. I think there's only downside risk. There's a lot of potential, but there's a lot of downside risk. You had UAE leave OPEC because they left OPEC. They left because they wanted to pump out as much oil as they want. They didn't want to have restrictions. They were fighting to have more capacity through OPEC, and they gave them a little bit more, but it's not enough, and they just want to keep increasing it. So they're going to crank out a lot of oil too. And I think they just had a pipeline that should be done in about 3 months. They started it three or 4 months ago, and it'll be done in 3 months. And we have a train in California that's taken 20 years and trillions of dollars and still hasn't done like a mile of track. So, UAE is cranking it out. So point is, they're going to put a lot more oil on the market. A lot of other places are going to put more oil on the market. The market's going to get flooded in no time, and it's going to drive down the price of oil. It's going to be great in a lot of areas. Energy companies is not one of them. But this is something you should be aware of. So if you listen to the show, what we talked about in March and April was one of the thesis of the year was Trump wants to retain power in the midterms. One way to do that is low oil prices. Another way is low mortgage rates, low interest rates. So far, the war has been I think we call it a shit show in technical terms in regards to getting his thesis, in regards to that thesis. But I will say that I think we'll eventually hit that low oil. I think we'll eventually hit $20, $30 oil, which is our prediction way back then. It may happen after the midterms. It most likely will. I think we're a little too shy on our prediction, but it is going to happen, and it's going to make people feel good. Money's going to be in their pockets, assuming that gas prices drop. At this point, what we're seeing is we're not seeing a drop in gas prices. I have a chart here I shared, and this is the gas prices. They're not coming down, so I expect they probably will come down. I'm not sure if they'll hit the lows before, but we may. We'll see. But these are just dynamics you should be aware of. And, I would stay clear of energy for this reason. Not energy, but oil-related energy. I love nuclear. I think there's going to be a lot of upside there. I think it's still a little early for nuclear, but I still think there's a lot of upside. The market is not recognizing it yet, which both good and bad. Bad in the sense that, we want the market to recognize that. So investments into nuclear start to play out. A lot of volatility in that sector, but there's still some opportunity there. I want to touch on gold and silver, and then I'll hand it back to Doug, and we'll wrap it up. So, we love gold. Gold's done well in the last few years. I actually liked it when it was doing this, when it was just climbing. It was going up 23% a year, somewhere thereabouts. It was great. Easy money. Don't take a lot of risk. You just crank it out. And then we had this blow off top, and now oil prices are going down. Well, people are freaking out. Oh my God, we're in gold. We're losing money. No, you're not. You went from $2,000 up to $5,500, and now it's down to $4,100. You still made lots of money. You're just in the last year, not even year, in the last 4 months, 5 months, you haven't. And that's okay, right? That's what happens in markets. They go up and then they go down, and they go up and then they go down. And you hope they do more up than down. But with gold and silver, and this is a silver chart, which looks much worse, a lot of people are looking at this saying, I don't understand, with all this inflation, with all the money printing, why is gold going down? Well, there's one major reason. One is that it went up I know this is a non-specific reason, but it's how markets work. There's too much money flowing in too quickly. It's not how the markets work. It got way overblown, and this needs to happen to take the air out of the sails and get back to where it was before. This is what gold does. It's always done this. You have a blow off, and then it recedes, and it'll probably stick here for a while, maybe go down a little bit more, but we'll get to a point where it'll settle and then it'll go up again. I think we've got another maybe 12, 24 months. I don't know, but I'm not expecting anything anytime soon. So just be aware. But just understand that in large part, this is because central banks are selling their gold because they don't have cash to buy oil and other things. So because of all the stuff going on, they're just selling their gold, which is fine. That's why they have it, right? But the fact they're selling it means that it's dumping on the market. Not enough people are buying it, so it's depressing the price. So that's what's going on in precious metals. Not a lot of exciting stuff in precious metals. Is not something I'm staying up and waiting for. I am excited because I do think there'll be an opportunity to buy it. I just don't think we're there yet. I think you can probably start taking chip shots. You can probably put in small positions if you don't own one. I think we go probably a little more downside, but I think it's worthwhile taking a flyer on and starting position. I already have a position, so I'm just going to wait it out. But I would probably start to look at positions, at least start now. Doesn't mean you have to go all in. I wouldn't do that yet because I don't think it's a no-brainer. But I do think we're looking at a place where it starts to make sense. So in terms of commodities, that's pretty much all I got to say about that. I did want to leave it with one thing, and I'll hand it back to Doug. And that one thing was. So July ends up being the best month statistically of the summer. June and August, not great. That's kind of been the inverse so far. June was okay, and July's not awesome. This week is down a little bit, but it's only because of the announcement. But typically Wall Street's away. They're not around, so it tends to be lower volume. There tend to be less opportunities. It tends to be a time where it's better just to sit in the sidelines and just you sit on your positions or whatever you're going to do, but don't go all crazy because it's just not a lot going on, not a lot of news. The news we've had has been uninteresting. The jobs report is underwhelming. Inflation has cooled a little bit in Europe. We'll see what happens next week with the CPI, but Fed's trying to determine whether they're going to raise rates or not. I don't think they are. I think they're in a position where they can't really make a move. And I don't think they should anyway. I think they should stay where they are. But I would continue to look for rotation. I would continue to look for rotation in the markets. Rotation's healthy. It's a good sign. You might not like it because the areas you're in may not go in your favor, but just keep in mind that the markets do go up and they do go down, and you want to pay attention to areas that are discounted, software being one of them. I'm not buying anything, but I'm paying attention. I think they look interesting. And the question is, how interesting? I don't know. But it does make sense to pay attention. So anyway, Doug, final thoughts from you, and we'll wrap it up here.
Yeah. So yeah, because we had some issues there with sharing. I want to jump back into real estate real quickly before I round it out, and I did throw some charts right there for you to cover. One of the things I think
your thing is not there.
No, I threw it into Slack for you.
Oh, you did. Okay,
Yeah,
got
the
it.
last thing. If you can just go in, kind of go in that order. But the one thing I think is really comes up about this housing market is how confusing it is. And of course, I'm sure there's people out there that have heard the doom saying with real estate is just, and I started to talk about the trend line. It's, and interesting, the number of days that a home sits on the market is right about the same as it was last year. So that's clearly not a significant trend that things are getting worse. But I want to go back and actually do some perspective. And that's looking at a 10-year chart. If we actually look at where housing is right now, which we talk about how locked up it is, we're actually looking at 53 days on average on market. But if we look at 2017, 2018, and 2019 pre-COVID, homes routinely sat on the market for 75 to 85 days before selling, much longer than they are now. And that was considered then a completely normal and functional housing market back then. The chart shows this. Now, there was a massive drop down to 30 days, 2021, 22, historical freak accident fueled by artificial low near zero interest rates, and an unsustainable buying frenzy that's not a permanent new normal. The current reality of 53 days, even though they are taking slightly longer to sell than they did last summer, barely, it's still significantly faster than the normal before the pandemic. So if anyone is panicking about the housing market freezing up because homes aren't selling in 24 hours or more, you look at the hard data from the Federal Reserve and homes are still faster than they were 10 years ago. So that right there itself is not crashing. It's actually returning to a normal everyday reality. However, when we overlay prices and mortgage rates on top of the 10-year chart, this narrative does shift completely. And it also reveals why the market feels entirely broken for regular people, even if homes are selling fast. If we expose the core illusion of the 2026 market prices, what we're seeing here is that the charts prove homes are still selling quickly. But don't let that fool you completely into thinking that the market is healthy, because in 2017, while a home sat on 80 days, it was a slow, normal market. We're currently living in more of a gridlock market where the prices are trapped at all-time highs. Borrowing costs are double what they used to be. And the only reason things are moving is that the supply is practically suffocated. So we got to go back to the pricing then. When homes sat for 75 to 85 days, then the price of median price of a house was $315,000. Mortgage rates hovering at 4%, and a monthly payment was highly affordable. Now we're looking at $430,000, a 30-year mortgage stubbornly stuck near 6.5%. So we're currently sitting what's called the golden handcuff effect. 80% of current homeowners have a mortgage rate below 5%, refusing to sell because they do not want to trade at 3% for a 6.5% mortgage. And sellers are roughly staying sidelined. Overall housing inventory historically low. Few buyers must move due to jobs, marriage, or babies. They're fighting over that tiny pool of available homes, and the artificial supply shortage is what's keeping homes selling relatively quickly. And it's also keeping prices elevated despite terrible affordability. If we then look at the chart that I posted there on buyers and sellers in the United States, we have record-breaking data. Sellers are outnumbering buyers. 46.3% more active sellers on the market than buyers. And to put that in perspective, 21 to 22, the pandemic frenzy, the chart plunged deep into negative territory. There were way more buyers than sellers. Buyers were fighting for scraps. 2015 to 2019, pre-COVID, the gap hovered a balanced level, typically about 10 to 15% more sellers than buyers. Today, we've got 50% more sellers than buyers. That is the largest supply-demand gap ever recorded since tracking, which only goes back to 2013. And so if you want to know how weird 2026 market data is, look at those two facts side by side. So yes, they're moving fast, but we have record-shattering more sellers than buyers. And how is this possible? Because the overall volume of the market is tiny. It's kind of like the stock market moves in the summer. Not a lot of moves. That means every move is compounded. So millions of buyers have packed up and left the market entirely, priced out. Sellers are listing homes, but they're shouting into an empty room. The only reason things look fast on paper is a few remaining buyers have to move quickly. One last data point that I want to put on that is that we are absolutely seeing that the trends are that there is ultimately a significant number of sellers. It is a buyer's market in the South. It is still a seller's market in the North. And I think that makes, it continues to add a massive trend issue. So depending on where you live, you're going to feel this differently. Going to wrap this up, here. I keep coming back to this thought. For me, that housing report wasn't really about houses. It's about life. You have millions of Americans who aren't staying where they are because they're in their dream home. Matter of fact, you've got a lot of people that bought that starter home that can't move up and are now building families too large and outsizing the home, but now can't move and they're financially stuck. A 3% mortgage is a golden handcuff. Moving costs more. Borrowing costs more. Renovations cost more. Rents, those are, again, you look at the price of new homes are now, versus existing homes. That you've got trends there that are now historically outside of the norms. Waiting feels safer than doing anything. And before long, 1 year could become 5. 5 could become 10. And then life is completely put on hold. And that's the concern for the younger generations. And truth is, housing isn't the only place they get stuck. We see it in retirement. People could retire but aren't sure if they can. Moving, freeing up liquidity. We see it in college planning. Families are writing checks because they don't know that there might be a better way. We see it in taxes. People are paying far more over their lifetime than they ever needed to. The price, you think of a home as expensive at $500,000, $600,000 average. That could be what you're going to be losing. That could be a fraction of what you're going to be losing in taxes if you don't manage that right. And of course, then we get back to the markets and investments. It's not because people are making bad decisions. It's because they made good decisions that were never connected in one coordinated plan. And so the question I'm going to leave everyone with is, your financial life, is it creating freedom? Or is it quietly creating limitations you don't even realize are there? Real wealth isn't measured by the size of your portfolio. It's a fact. I know that we look there thinking the more we have, the better we could be. But, Jason Bateman talked about it. His ability to have income and cash flow, this was a recent podcast that he was on, made him feel more comfortable than his peers who inherited money because they had a portfolio. They were afraid they could go through it and lose it. So it's measured by the number of choices in your financial life and what that gives you. Can you retire when you're ready? Can you help your kids? Can you weather bear markets? You say yes to opportunities instead of worrying. At Emergent Advisors, we start with the wealth mapping. Before anything recommended, we map everything. So you can finally see how income, investments, taxes, retirement, college planning, insurance, estate all fits together. Something remarkable begins to happen at the point. You stop wondering, you stop hoping, and you start making decisions with confidence. So if you've been listening today and found yourself thinking, I wonder if there's something we've missed, don't wait till retirement to find out. Visit emergentadvisors.net, MERGENT, emergentadvisors.net. The goal isn't simply to accumulate wealth, it's to build a financial life that gives you the freedom to live on your terms. Hope is not a financial strategy. Confidence is, and confidence comes from knowing, not wondering. And again, Kurt, as always, thank you for having me.
Awesome. Thanks for coming on, Doug. And that's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app you're choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think, but investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest